Welcome to the deep dive. We're here to really cut through the noise.
Yeah, get straight to the core stuff.
Yeah, exactly.
Huh.
The most important knowledge nuggets, hidden inside a specific source document. Think of it as your shortcut.
A shortcut to being genuinely well-informed on exactly what's in front of us. We take a source, like today, this one key document.
I'll guide you through it.
Extracting those core insights, the surprising facts, the stuff that really matters.
And for this deep dive, we are cracking open a prospectus. It's dated April 30, 2025.
Right.
Specifically for the initial public offering, the IPO, of Ather Energy Limited.
And just to be clear, this isn't us giving market commentary or, reacting to news.
Yeah.
This is a direct look. What did Ather Energy actually tell prospective investors? In their own words, their own numbers, as they tried to go public.
Everything we talk about today comes straight from this one specific filing.
That specific document.
So if you're interested in understanding what this Indian company, they call themselves a pure play EV company.
Focused on electric two-wheelers.
Right, two-wheelers and their whole ecosystem. If you want to know what they revealed about their structure, their plans, finances for this IPO,
then this deep dive is absolutely for you.
Let's unpack this document.
Okay, so where do we start? How about the basics? The company itself.
Good idea. Foundation first.
According to the prospectus, Ather Energy Limited, it actually started quite a while back, incorporated as a private company, October 2013.
Okay, so they've been around.
Yeah, but they only converted to a public limited company much more recently, August 2024.
Right before the IPO process really kicked off, presumably.
Exactly, getting ready for this offering.
And the filing, it clearly names the key players, the promoters.
Yep, you've got Tarun Sanjay Mehta, Swapnil Babanlal Jain,
The founders.
and Hero MotoCorp Limited, HMCL.
Interesting. And it gives the addresses to registered office, corporate office, grounds it physically.
Okay, now the offer itself, the IPO, what are we looking at?
Well, the structure is a 100% book-built offer process.
Standard stuff for a large IPO like this.
And the prospectus, it details the sheer scale. I mean, the total offer.
It's big.
92,867,945 equity shares.
Wow.
Aiming to raise up to 29,808 million.
Nearly 30 billion rupees? That's significant capital, though they do add the usual disclaimer.
Subject to the final basis of allotment, yeah. Always.
But here's a key point. That total figure, it's split. The money goes to different places.
Right. Crucial distinction. First part is the fresh issue.
This is the money going into Ather Energy, capital for the company.
And that's the bulk of it. 81,816,199 shares, raising up to 26,260 million.
Further stated plans, which we'll get to.
And then the second part.
That's the offer for sale, the OFS.
This is where existing shareholders are selling their shares. Cashing out, basically.
Exactly. And that money goes straight to those selling shareholders, not into Ather's bank account.
And that accounts for 11,051,746 shares, valued at up to 3,548 million.
The document also puts the whole offer in context. The IPO represents 24.93%.
Call it roughly a quarter.
Of Ather's total paid-up equity share capital after the offer completes.
Okay, now the price. This bit really caught my eye. The offer price was fixed at $321 per share.
Right?
But the face value, just €1 per share.
So a massive premium. 320 premium on every single share.
Yeah. It tells you something about the valuation they were aiming for. The price band for bidding was set between 304 and that cap price of 321.
And they carved out a piece for employees, too.
Right, the employee reservation portion. Up to 100,000 shares set aside.
With a sweetener, a discount.
Yep, a 30 discount per share off the offer price for eligible employees.
There are some limits mentioned, too, on how much employees could bid. Max 500,000 after the discount, but initial allotment capped lower at 200,000 net.
So you take out that employee chunk, and what's left is the net offer.
Right. That's for everyone else, and that represents 24.91% of the post-offer capital.
And the prospectus lays out the usual allocation structure under SEBI rules. The biggest slice, at least 75% of that net offer.
Goes to the big players, qualified institutional buyers, QIBs.
And within that QIB pot, there's the anchor investor portion.
Up to 60% of the QIB part could go to anchors. These are the institutions that commit early, before the public offer opens.
And they specifically mention a preference for domestic mutual funds to get at least a third of that anchor allocation.
Interesting. What about other investors?
Well, not more than 15% of the net offer was for non-institutional bidders, NIIs, split into categories based on how much they applied for.
Okay.
And then not more than 10% of the net offer for retail individual investors, RIIs. us regular folks.
And the document notes only RIIs and the employees bidding in the reserve section could bid at the cutoff price.
Which, as we know, ended up being the final offer price of $321.
Got it. And the minimum application size?
Minimum bid lot was 46 equity shares, so you had to apply for at least that many.
Okay. The dates were also laid out pretty clearly. Anchor bidding, April 25th.
Public offer opened April 28th, closed April 30th, 2025. Pretty quick window.
And they required most bidders to use the ASPA process.
Application supported by blocked amount.
Yeah.
Your money gets blocked in your bank account. Standard procedure now.
Yep. And the listing plans?
Both major exchanges, BSE and NSE, with NSE designated as the main one, the designated stock exchange.
Okay. Comprehensive on the structure. Now, you mentioned the offer for sale.
Right, where existing shareholders sell.
Yeah.
Who exactly is selling?
The prospectus names them. You've got the two founder promoters, Tarun Mehta and Swapnil Jain, selling some shares.
Okay. Founders taking some money off the table, common in IPOs.
Yes. And alongside them, several institutional investors. Caladium Investment, National Investment and Infrastructure Fund 2, Internet Fund 3.
Plus some really early backers, ITM Incubation Cell, ITMS Rural Technology, and Business Incubator.
And one individual, Amit Patia.
So, a mix of sellers. But here's where it gets really, really interesting. The prospectus gives the weighted average cost of acquisition, the WACA, for these sellers.
Ah, yes. This tells you what they paid for their shares, on average. It's fascinating.
It really is. It gives you such a clear window into their entry points.
You see the founders, Tarun and Swapnil, their WACA is 21.09 per share.
Okay.
Then you have the super early backers, like IITM Incubation Cell, listed at nil WACA.
Nil. Basically, free shares likely for incubation support.
Or IITMS Rural Technology, very low, 8.31.
Now, contrast that with the later, maybe venture capital or private equity stage investors.
Exactly. Caladium Investment, their WACA is way higher, 284.24.
Big difference.
And NIF2, the National Investment and Infrastructure Fund, at 183.71.
So you compare those costs from nil or 8 to over 204 against the offer price of 321.
And you instantly see the massive difference in potential returns for these sellers. It really paints a picture of the company's valuation journey over time, seen through these investors' eyes.
Absolutely. Now let's switch back to the fresh issue. The big chunk of money going into Ather.
Right. Where's that $26 billion plus going? The prospectus is specific. Objects of the offer.
And the plans look ambitious,
Yeah.
focused on growth.
Definitely. The biggest single item of $9,272 million earmarked for capital expenditure.
Or what exactly?
A brand new electric two-wheeler factory in Maharashtra.
Okay, significant capacity expansion planned. What else?
Another $400 million for repaying or prepaying some existing debt, cleaning up the balance sheet a bit.
Sensible.
Then a really substantial amount, $7,500 million, for investment in R&D, research and development.
So focusing on future tech, new products, presumably, that's a big chunk.
It is. And another euro 3,000 million is allocated for marketing initiatives.
Driving sales, building the brand. Makes sense if they're expanding production.
And the rest, 4,922 million, is for general corporate purposes, with the usual note that it won't exceed 25% of the gross proceeds.
So bottom line, this IPO cash is clearly meant to fuel major expansion, R&D, and market presence.
No doubt about it. Okay, let's shift gears. What does the prospectus tell us about the business itself and the market they operate in?
The summary gives a decent overview. Ather designs in India, does in-house assembly.
They build their own battery packs, which is interesting, but they buy the actual cells from elsewhere.
Right, and they outsource other bits, like motors and chargers.
They also highlight their software, Ather Stack. Features like navigation, analytics, positioning themselves as premium.
Yeah, that seems key to their strategy, the premium end of the market.
And the industry context they provide. They stress that India is the world's biggest market for motorized two-wheelers. Huge potential.
And they point to a trend within that market towards more premium vehicles.
Plus, obviously, the big story, the expected massive growth in electric two-wheelers. They project 10.3 to 12.3 million units a year by FY31.
That's huge growth from where things are now. What do they say is driving that?
Several factors listed, more EV models becoming available, obviously. Crucially, government support.
Ah, yes, the subsidies.
They mention FAME, EMPS, and the newer PM eDrive scheme specifically. Those subsidies make a big difference to the upfront costs for consumers.
Definitely. What else?
Developing charging infrastructure, which is still a work in progress but improving, falling battery prices over time, and improvements in local manufacturing.
All sounds logical. Does the prospectus mention Ather's market share?
It does, citing a CRISIL report. For the 9 months ending December 2024, they state a 10.7% share of the Indian E2W market.
Okay. And for the full previous fiscal year?
Slightly higher, 11.5% for fiscal year 2024.
Right. And you mentioned this CRISIL report.
Yeah, the filing clearly discloses that the report was commissioned and paid for by Ather.
Which is standard practice for IPOs needing market data. But it's a detail you, as a potential investor, definitely need to note when assessing that data.
Absolutely. Context is everything.
Okay, now, the financials. This is where, based on their own disclosures in the summary, things get really interesting and maybe a bit concerning.
Yeah, this section requires careful reading. The data comes from restated financial information, covers recent periods, the 9 months ending September 2024 and 2023, and the full fiscal years ending March 2024, 2023, and 2022.
And they add the caveat that 9-month data isn't always indicative of a full year. Standard warning.
But what really leaps out from the summary statements, Ather states clearly they have incurred losses continuously since incorporation.
Since day one. Not just recent losses, continuous losses.
And they give figures. Loss before tax, $5,779 million in the first 9 months of FY25, ending Decade 2024.
And for the full year before that, FY24.
Even larger, a loss of $10,597 million. Over 10 billion rupees lost before tax in 1 year.
Wow, that's substantial. And wasn't there something about revenue growth too?
Yes, the document explicitly points out stagnant revenue growth in fiscal year 2024 compared to FY23.
So losses widening or staying high while revenue growth stalled in that period. Not ideal.
Not ideal at all, and maybe the most critical point for understanding the operational health.
Let me guess. Cash flow.
Bingo. The prospectus states very clearly they have incurred negative cash flows from operations continuously since incorporation.
Burning cash, year after year, from their actual business operations.
The figures given are stark. Negative 7,171 million cash flow from operations in the 9 months ending December 2024.
And for the full FY24.
Negative euros 676 million, still burning cash, though less than the loss figure suggests, maybe due to working capital changes, but still negative.
So let's just hammer this home. Continuous losses since they started, stagnant revenue in FY24, and continuously burning cash just running the business.
That's what the document states. It puts that huge IPO fundraising, especially the part for expansion and R&D, into sharp focus, doesn't it?
It really does. They need this external funding to keep going and execute those plans, given the operational cash burn.
Seems unavoidable based on these figures. They also mention using some non-GAAP metrics, like adjusted gross margin and EBITDA.
But they add a note of caution.
Right. That the calculation relies on their internal systems, which carries inherent risk. They also include a table showing the pre-offer shareholdings of the promoters and selling shareholders.
Okay. So a tough financial picture painted by their own disclosures. What about the risks? Does the prospectus highlight specific dangers?
Oh, yes. They are legally obligated to, and they do, very clearly.
What are the big ones?
First, the first public issue risk. Standard, but important, no formal market for the shares existed before this IPO.
So the offer price might not hold up once trading starts.
Exactly. No guarantee it reflects the future price, and no guarantee the shares will trade actively or consistently. Liquidity risk.
And the general warnings.
Yep, the general investment risk disclosure. Very blunt. Investing involved risk.
You can lose everything.
They state that explicitly. Possibility of losing your entire investment. And they emphasize that you, the potential investor, must rely on your own examination of the company, the offer, and the risks.
And they make it clear regulators aren't endorsing it.
Unambiguously. SEBI hasn't recommended or approved the shares, nor have they vouched for the prospectus's accuracy or adequacy. Buyer beware, essentially.
Beyond those general warnings, what specific risks related to Ather did they flag?
Several are mentioned in the forward-looking statements section summary. Things like potential reliance on a limited number of suppliers.
Supply chain vulnerability.
Right. Risk of customer complaints. Challenges tied to their limited operating history. They haven't been mass market for that long.
And dependence on market adoption speed. The whole EV transition.
Huge dependency there. If adoption slows, it hits them hard.
Any product-specific risks mentioned?
Yes, notably the risk of battery fire or smoke. That's a known concern across the EV industry, and they flag it.
Important to acknowledge. What else?
Reliance on imports, specifically mentioning China. Potential for disruptions there.
Geopolitical and supply chain risks again.
And they disclose outstanding legal proceedings against the company itself, its promoters and directors.
And they note those could have adverse impacts on the business if they lose.
Naturally. They also state that the company and the selling shareholders accept responsibility for the prospectus content.
But with caveats for the sellers.
Right. Limitations for selling shareholders on info not specific to them.
And they reiterate the point about the Chrysalis report.
Yes, they mention the reliance on that commission report and the associated risk that comes with using data you paid for in your offer document.
Wow. Okay, that was definitely a deep dive. We've really pulled apart the key elements Ather presented.
Yeah, we covered a lot. Company origins, the IPO structure size, fresh issue versus offer for sale, the pricing, that big premium.
The allocation breakdown. Then we looked at who was selling in the OFS and those fascinating WACA figures showing different entry points.
Huge differences there, and we detailed where the fresh issue money is supposed to go, that new factory, R&D, marketing.
All set against the industry backdrop, they describe big market potential, EV growth drivers, their market share according to that commission report.
And then the really critical part, the financial picture they disclosed. History of losses, stagnant revenue in FY24, and that continuous negative cash flow from operations.
Underscoring their reliance on this IPO funding.
Absolutely. And finally, we covered the key risk they highlighted themselves, from general IPO risks to very specific operational, market, product, and legal risks.
And it's crucial to remember, every single fact, figure, plan, and risk we discussed today
came directly from the pages of that specific document, the Ather Energy Prospectus, dated April 30th, 2025.
By walking through this, you've essentially gotten a direct look at what prospective investors were shown, the company's own narrative.
Cutting through the noise, getting straight to the source material.
So here's the final thought for you to chew on. We have this document laying out ambitious growth plans, a new factory, lots of R&D, marketing pushes, all fueled by this IPO money.
But on the other hand, the same document explicitly reveals a history of continuous losses and persistent negative operating cash flow. They're burning cash.
So how do you weigh that? The potential for future growth, which looks significant if the EV market booms as projected, against the stark financial reality presented right now, and the specific risks the company itself outlined. Risks like market adoption speed, competition, reliance on funding.
Considering everything we unpack from this specific prospectus, what stands out to you as the single most critical piece of information for someone trying to evaluate this potential investment opportunity, balancing that growth story against the disclosed challenges?